I'm Bias Trading here, and today we're going over the summary of Trade Like a Hedge Fund. Now, this book covers a lot of strategies. There's about 20 different strategies and techniques that hedge funds use to make profitable trades that he goes over. I'm going to be going over around five in two different categories, and hopefully this gives you enough examples for you to kind of get into it and actually try the book out for yourself. As I think it's probably one of the best books if you're looking into statistics and performance metrics and overall actually creating systems. So first is the gap strategies. So the gap trade is probably one of the most popular strategies among day traders and hedge funds. Many day traders only play gaps and fade them. They short gap ups until they get back to flat with the previous day close, or they can even go long on gap downs, for example. Now, so the key to success in playing gaps is to identify those situations where it's most probable than normal for them to fade. And the way he states you should do this is by research and creating systems as described in the following kind of systems. So here's a couple different gap strategies that he mentions and a small summary about them. So system one is filling the gap. This involves buying a stock when it opens more than 2% lower than the previous day's closing price and selling at the previous day's closing price, or at the end of the day if it was never hit. Now, the system did yield some okay profits, but it's definitely not ideal after taking into account commissions and slippage of trading individual stocks. System 2 was filling the gap after a down day. So this was similar to System 1, but only buying when the previous day had a down day for the stock. And then this system yielded slightly higher profits than System 1, but it still might not be enough when taking into account commissions and slippage and other factors. System 3 was the 5% gap. This involves buying a stock when it is opening 5% lower than the previous day's close, and the previous day was a down day as well for the stock. This system produced way better profits than the first two systems, and this was the first sign of a probable and likely system you could use. Now, system 4 was the 5% gap with a market gap as well. This involves buying a stock when it meets the criteria for system 3, but it also has a QQQ or a NASDAQ 100 is gapping down at least 1.5% as well. This system resulted in the highest profits per trade of all the systems I mentioned, and this is a great way of how he goes through different systems and the evolutions of them and testing out different metrics to see how they change. And I think this is a great way to start building up your curiosity mindset for being more of a system trader. Now, two, this was actually something I've kind of created into a futures algo. This is going to be quite a lengthy summary of this kind of way of trading, which is pairs trading. So please forgive me if it becomes a bit too complex. However, I highly recommend checking out the book, and you'll be able to read through the whole, I think it's about 2 pages on this particular strategy. Now, pairs trading is a popular investment strategy used by many hedge funds, which involves taking positions in two assets that are highly correlated with each other, with the expectation that the spread between the two assets will eventually converge to its historical norm. Normally, pairs trading is implemented as a market neutral strategy where one goes long on one asset and short on the other asset. However, unilateral pair trading involves taking only one side of the pair, which at first glance might seem contradictory in terms. So this is when you trade a pair, although you are usually neutral on the market, you are in fact making a very biased bet on the direction of the spread between these two asset classes. As an example, if you were to use GM and Ford, and they normally trade in lockstep with each other, so that means they're very norm spread distribution. But then suddenly, Ford suddenly moves down a lot sharply compared to GM. One might short GM and go long on Ford. With that idea, the spread between the two stocks should go back to its historical norm. In other words, we are betting on a mean reversion of the spread. Now, the preferred stock arbitrage strategy discussed in the book is a bit different than the normal pairs trading strategy, in that the key to success of a convertible arbitrage strategy is not the one of betting on the direction of the spread, but rather on getting on an exorbitant yield. So if the spread went in the trader's direction, that would be great. Otherwise, it would not be a big deal, as they would have kind of counteracted that with a neutral spread. Now, pairs trading often involves heavy doses of leverage because spreads of highly correlated assets might only need to get a tiny bit out of sync to make the trade worthwhile. Leverage in these situations is where many hedge funds get into trouble. In 99 out of 100 times, the spread might get back into shape, but if that one or two times gets out of line, then you could be in a different scenario where you're having a 20% return on the year and then minus 50% at the end of the year. The other problem with pairs trading in general is that there are many billions of dollars in hedge funds doing this kind of style of trading. So a lot of these edges have kind of faded away over time. However, even on my futures algo, I was able to accomplish a similar version of this spread. I think this book was written in 2004 or 2008. So a lot of it is slightly outdated, but if you try and put your own swing on them, or understand them on how they apply to today's markets, and then go do your own backtesting and research, you can actually find very good similar versions of these, just with some different kind of use cases. Now, the key difference is when you're using unilateral pairs trading is that we will not trade both sides of the spread, but the side that is historically more volatile. The idea is that the more volatile the side, the more often the culprit for why the spread has gone for this different reason. For this reason, you could use QQ and SPY as a pair, but will only trade QQQ because it is more volatile. So here you are betting on, because it has created the deviation between the spread, whatever side you take, based on the more volatile instrument, it would more likely to continue that spread deviation compared to revert back to the norm, because it's the one that's caused it. Now, this book also includes a wide range of helpful graphs and performance metrics that can be extremely useful to readers and kind of newcomers to backtesting. These visual representations provide a clear and concise way to analyze and understand the performance of various trading strategies. This book not only covers basic performance metrics such as profit and loss, but also more advanced ones like Sharpe ratios and drawdown graphs. These metrics are accompanied by clear and intuitive graphs that allow readers to easily visualize the impact of different trading strategies over time. This combination of graphs and performance metrics is particularly helpful for people who are new to backtesting and want to see kind of what graphs and visualization methods you can use. Keep in mind, some of these are a bit outdated, and I think you could do a lot better, but overall, it's a great starting place. Now, thank you for watching, and if you enjoyed, please like and share it with anyone else who might be interested.